Hey there, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned into Next Level Charting. Thank you very much for joining us. I appreciate it. If you're watching this video on YouTube, and you like it, of course, please give us a thumbs up and consider subscribing. So I'm going to start off with some weekly charts today because I want to get some perspective and allow for some volatility because we still got the Fed to come because I'm recording on Wednesday. We'll look at the large caps, small caps, mid caps, and micro caps and how they're performing. Then we're going to look at 3 breadth indicators to watch for signs of a bear market in the S&P 500. And then we're going to look at a ratio chart measuring risk on and risk off. So I'm recording this on Wednesday around noon, and the Fed is meeting as I speak. And I do have my cell phone turned on just in case Chairman Powell decides to call for advice. So if you hear a call, I'll have to break off from this recording. So I'm going to start off with some weekly charts because I want to get some perspective here because who knows what's going to happen after the Fed announcement. And the day after the Fed announcement, there can be a lot of whipsaw. We've seen volatility increase a lot since basically Black Friday. That's the day volatility started increasing, and it remains high. But these weekly charts here, they're very simple, just weekly close-only prices here. This is SPY. We've got the red line, which is the 40-week moving average. So SPY is clearly in an uptrend. It's above the rising 40-week. It hit a new high there, weekly closing basis. So it's still in an uptrend. And if we look at the 540-week EMA crossover here, which is represented by the PPO 540, we can see that the 5-week EMA is 6.584% above the 40-week EMA. So still an uptrend there. Now what I'm noticing is when you go down in market cap, you're going up in relative weakness and underperformance. So, and that makes kind of sense because when you go down in market cap, you also have increased risk. You have a higher beta. So that's what we're seeing in the market. We're seeing a move away from risk, and that is reflected when we go down in market cap. So the next one we have here is the S&P 500 equal weight ETF RSP. Represents the average stock in the S&P 500, and you can see it's still above its rising 40-week moving average, but did not get a new high there. So a bit of a non-confirmation, and it is the 5-week is above the 40-week EMA, but not as much. But all in all, SPY and RSP are doing okay. And then we get to mid caps, and we already start to see some trouble because you can see we close below the 40-week EMA 3 weeks ago. We're below it now. We'll see where we close this week. And if you can see the 540-week PPO there is at 3.46%. So this one is less strong. Yeah, what looked like was a breakout there in November, but it failed, moved back into this consolidation zone. So you go down to mid caps and you're at the 40-week basically. Then we go to small caps, IJR. And right away, we can see we're below the 40-week. So we're breaking down there. We had this head fake breakout and then this sharp decline, and we've broken below the 40-week. The 5-week EMA is still above the 40-week EMA, though. And then we get to the Russell 2000. The Russell 2000 is even, how shall I say, the quality is less than the stocks in the S&P 600. So the S&P 600 small cap index ETF, you've got 600 small caps. Well, the Russell 2000's got another 1,400 that are even smaller because you have to go even smaller to find those 1,400, if you will. And you can see that the Russell 2000 here, ETF IWM, is broken below its summer lows. It's well below the 200-day or the 40-week, and the 40-week is turning over. And you can see that the 5-week EMA is poised to cross below the 40-week EMA via the PPO here. So going down in market cap, we're seeing more weakness. Here's QQQ, which is basically as strong as SPY. It's in an uptrend. And this, of course, is dominated by the big 6 stocks in the ETF. I'm going to skip DIA, and then I'm going to go to microcaps, Russell Microcap ETF, and look at that. Gone nowhere, did not get a breakout there in November, and we're breaking down. And you can see the 540-week EMA crossover is negative. So a lot of weakness, or should I say a downtrend in microcaps. Here's the main analysis page at Trend Investor Pro. And on Tuesday, I was going over the signs of risk off, if you will, high beta versus low volatility, defensive sectors leading. Then I looked at gold and it was firming. And I'm going to show some of these ratio charts here today using StockCharts. And I want to point out that if you do subscribe to trendinvestorpro.com, and I do specialize in ETFs here, I've got a bonus. I've got an ETF chart list that has 200 plus ETFs organized in a logical top-down manner. This is for StockCharts subscribers because you need a StockCharts chart list to get this. And also the essential breadth indicator chart list because I'm going to show 3 breadth indicators that we can watch for signs of a downturn or a bear market in the S&P 500. So check out trendinvestorpro.com if you're interested in those bonuses and our services. So I'm going to work off of the essential breadth indicator chart list, and I'm going to scroll down because I want to show you 3 indicators to watch for signs of a downturn in the S&P 500, that all elusive 10 to 20% correction. The first one is the high-low line. And the high-low line has been rising since the middle of 2020. There you can see it there. There's a pink line, which is 10-day EMA. And this is a cumulative measure of net new highs. So you've got new highs in green, new lows in red, and then you got high-low percent here in the middle window there, and then the high-low line. And it almost touched the 10-day EMA on the pullback recently, but didn't. On this next chart here, I've got a 3-month chart to show you. We had a dip, but did not go below the 10-day EMA, a very smooth line. And it's been on the right side of this bull run the whole time. And so if we get an uptick in new lows and that line crosses, that's going to be a negative. So that's the first breadth indicator I'm watching. And then the next one is going to be the bullish percent index for the S&P 500. Because keep in mind, it ain't over until the S&P 500 cries uncle. And right now, the S&P 500 hasn't. And I know the S&P 500 is dominated by large caps, but if you look at these breadth indicators, they have yet to turn over. So there are pockets of weakness, but there aren't enough pockets of weakness to trigger that bear in the S&P 500. So with this bullish percent index, what I'm looking at is across above 60% is bullish, and across below 40% is bearish. And the bullish percent index measures the percentage of stocks in the S&P 500 that are on point and figure double top breakouts, buy signals. And so if, say, 60% are on double top breakouts, that means 40% are on double bottom breakdowns. So a double top breakout is a higher high, and a double bottom breakdown is a lower low. And this is a great breadth indicator, and it shows you how many stocks are making higher highs and the percentage of stocks making higher highs in the S&P 500. Now, instead of using that 50% line, I like to give it a buffer, 60% and 40% to reduce whipsaws. You're not going to eliminate them. They're going to happen, but I want to reduce those whipsaws and catch the trends. And you can see here, we had a February 27th bearish signal below 40%. We got bullish there in March, but then got a whipsaw in May, but we've been bullish ever since May. And you can see there's been plenty of dips below 50%, but we haven't got that dip below 40%. And that's the second indicator I'm watching. And then the third one is the percentage of stocks with a silver cross. And a silver cross is when the 20-day EMA crosses above the 50-day EMA. And so the more stocks with a silver cross, a bullish silver cross, the better. And this indicator is from Decision Point. And you can see here that I'm using the same thing, 60-40 for it. So a move above 60% is bullish. And you can see it captured that bull run in 2017. Got bearish in 2018 with the move below 40%. And, there are going to be some whipsaws, but got out of this bear decline in 2018, caught most of this bull run, got out at the end of February there, and got in early June. And this indicator has been bullish since early June. Now, one thing you'll notice on here, the red lines, those are divergences. And I think negative divergences are probably the most misleading indicator out there. I think you're better off ignoring negative divergences, bearish divergences, because here you can see a bearish divergence didn't get a big reversal, instead moved to new highs. Here we can see a bearish divergence, and then we moved to new highs. Here again in 2020, a bearish divergence. Maybe it led to this correction, but it didn't lead to a serious downturn. And again, here we are from May to August, September, a big bearish divergence, but we moved to new highs. And until we cross below 40%, we don't have enough participation on the downside. So if we go below 40%, that's going to mean 60+% of stocks have double bottom breakdowns or bearish signals, have silver cross, net bearish silver crosses where the 20-day EMA moved below the 50-day EMA. And when that happens, then we have something to be concerned about. So they've seen it, 3 indicators. If 2 of those 3 trigger, then I think the bears will be in control of the S&P 500. So before looking at this next ratio chart, I want to show you the reason I'm using these 2 ETFs. I'm using the S&P 500 high beta ETF because it represents the appetite for risk in the stock market, the S&P 500. And you can see the biggest sector is information technology, 39%, consumer discretionary, 17%, financials, 13.5%, energy, 11.5%. But clearly a lot of beta going in from information technology, consumer discretionary sectors. And then if we look at the low volatility ETF, you can see the profile is different. Low volatility defensive sectors are dominating. Staples, 21%, utilities, 20%, healthcare, 11.75%. And so the way we track the risk aversion or risk on, risk off is with the ratio. And when that ratio rises, that means high beta is outperforming and there is risk on. And when it falls, that means high beta is underperforming or defense is outperforming. And that is a headwind for the market. And you can see here from late October until March, serious outperformance in high beta, and it remained strong until summer when it got hit, and then had a little bounce, and it's getting hit again. So high beta is underperforming within the S&P 500, and that means defense is leading, and that shows you that there is risk aversion in the stock market, in the S&P 500, the 800-pound gorilla in the stock market. And so this is a warning, and if we get signals, bearish signals from 2 of those 3 breadth indicators I showed you, that would mean that we are in a bear market, or at least a correction is in the offing for the S&P 500 and the broader market. So if you'd like to know more about trendinvestorpro.com, you can click on the link below in the description. Again, if you like this video, please give us a thumbs up and consider subscribing to StockCharts. Thanks again for tuning in. Have a great day, and I'll talk to you again next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.